Hey there, Finance Intel family. Today we're diving deep into the financial waters, but don't worry, I've brought my floaties for everyone. We're going to demystify some core financial concepts that everyone should understand regardless of your background. Because let's be real, the world of money can feel like a secret language, and it's time we all became fluent. First up, taxes. Ugh, I know. Just mentioning the word can make some of us break out in a cold sweat. But let's look at it differently. Think of taxes as the membership fee for civilization. When you earn money, a portion goes to the government. Why? Because those funds build the roads you drive on, the schools your kids attend, and fund crucial public services that keep our society running smoothly. It's the collective contribution that makes things work. Now, not all taxes are created equal. We've got income tax, which is a slice of your earnings. Then there's sales tax, that little extra bite you see on your receipt when you buy something. And for all you aspiring investors out there, keep an eye on capital gains tax, which applies to the profits you make from selling investments. It's like the government saying, nice profit, we'll take a little piece. We also contribute to things like Social Security tax and Medicare tax. Social Security is essentially a forced savings plan for your retirement designed to give you a financial safety net later in life. Medicare, on the other hand, is a health insurance tax that supports older individuals or those with serious health issues. It's about collective well-being. And then the annual ritual, filing your taxes. The government knows what you owe, but they make you figure it out. It's a bit of a guessing game, but getting it right means peace of mind. While taxes can feel like a burden, remember, countries with higher tax rates often boast a higher quality of life. It's a trade-off, but often a worthwhile one. Next up, banks. Many of us see banks as giant safes, diligently guarding our hard-earned cash. But the truth is far more dynamic. Banks are more like financial matchmakers. When you deposit money, they don't just stash it in a vault. A significant portion of that money is lent out to others. Individuals buying homes, businesses expanding, or even someone finally getting that jet ski they've always dreamed of. This system is called fractional reserve banking, and it works on the premise that not everyone will withdraw all their money at once. Unless, of course, it's 2008 and everyone panics, but that's a story for another time. So how do banks actually make their money? It's pretty straightforward. They lend your money out at a higher interest rate than they pay you for keeping it with them. You're the supply of money and borrowers are the demand. It's a classic economic dance. But why should you trust a bank with your money? Well, for starters, convenience. Paying with a card or transferring funds is a lot easier than lugging around wads of cash. Plus, banks actually pay you to hold your money in the form of interest. And perhaps most importantly, safety. Your money is much more secure in a bank than under your mattress. In the US, most banks are insured up to $250,000 per person, meaning your savings are protected even if the bank were to face unforeseen challenges. That's peace of mind right there. Now, let's talk about interest. This is a concept that can either be your best friend or your worst enemy in the financial world. Simply put, interest is the cost of borrowing money or the reward for lending it. There are two main types of interest: simple interest and compound interest. Simple interest is like a flat fee. You borrow $1,000 at 10% simple interest, you pay back $100 in interest. Easy. But compound interest, that's where the magic or the nightmare happens. Compound interest is interest earning interest. It's like your money starts having clones, and those clones also demand rent. Imagine you have a credit card with 20% compound interest. You miss a payment, and suddenly the interest from that missed payment starts earning its own interest. That $12 burrito can quickly morph into a $50 financial regret. On the flip side, imagine investing with 7% annual compound interest. Your money isn't just growing, it's duplicating itself like a cheat code. That $100 becomes $200, then $400, and one day you wake up a little older, a lot richer, and probably a touch smug about it. This is why interest is the silent engine behind both immense wealth and crippling debt. In loans, it's the slow burn that can turn small mistakes into financial fires. In investments, it's the time bomb that turns small gains into massive wins. So the hack? If you're paying interest, kill it fast. If you're earning interest, let it sit, feed it, and give it time. Interest is either your worst enemy or your best unpaid employee. The choice, my friends, is yours. Now, let's tackle inflation. Have you ever bought your favorite snack, only to open the bag and find it's half empty, yet you paid 30% more than last time? That, my friends, is the insidious bite of inflation. Inflation is the slow, steady erosion of your money's purchasing power over time. Your $5 bill is still a $5 bill, but it buys fewer noodles, less gas, and simply doesn't hold the same value it once did. What causes this sneaky phenomenon? Sometimes it's simply too much money chasing too few goods. Everyone has cash and everyone wants to buy the same things, driving up prices. Imagine 2,000 people wanting a $500 TV, but only 1,000 are available. The seller's going to say, this TV is now $800. Other times it's supply chain hiccups or increased production costs that force prices higher. And sometimes it's just our own expectations. If people think prices are rising, they'll spend more now, which actually causes prices to rise faster, a self-fulfilling economic prophecy. A little inflation, around 2% a year, is actually normal and even considered healthy for an economy. It encourages spending and growth. But when it spikes, savings get hammered, wages struggle to keep up, and life becomes tougher. To combat this, governments often raise interest rates. This makes borrowing more expensive, so people have less money to spend, which in turn cools off the economy and brings inflation down. It's a delicate balancing act. Speaking of economic ups and downs, let's talk about recessions. A recession is typically defined as a significant decline in economic activity lasting for at least 2 consecutive quarters, or 6 months. In simpler terms, one day you're cruising along, job is good, bills are paid, maybe even planning a vacation. Then suddenly, layoffs hit, the stock market tumbles, and everyone starts tightening their belts, saving money for essentials rather than luxuries. What triggers these economic downturns? It can be a cocktail of factors. High interest rates making borrowing too expensive, a global crisis like a war or a pandemic, or even just the natural rhythm of the economic cycle. Think of the economy as a party. In the boom phase, everyone's dancing, drinks are flowing, but eventually the lights flicker, reality sets in, someone checks their bank account, and suddenly the DJ is playing sad lo-fi beats about corporate downsizing. Recessions aren't forever. They're painful resets. Governments step in with measures like lowering interest rates or issuing stimulus checks to get people spending again. Eventually, businesses rebuild, growth resumes, but not without leaving some scars. The key is to understand that these cycles are part of economic life, and being prepared can make all the difference.
Next up, credit scores. This is that mysterious 3-digit number that seems to hold so much sway over our financial lives. It's a shadowy algorithm that knows your financial past and predicts your future trustworthiness as a borrower. This number isn't about how wealthy you are, it's about whether lenders can trust you to pay back money they loan you. Credit scores typically range from 300 to 850. Below 580, you're a walking red flag. Over 750, you're sparkling with adult credibility. Most of us hover somewhere in the middle, between 640 and 790. So, what goes into calculating this magical number? Payment history is king. Do you pay your bills on time? Credit utilization refers to how much credit you're using versus how much you could use. Keep that low. Credit age is how long you've had accounts. Older accounts generally look better. Credit mix means having a variety of credit, like cards, loans, and mortgages. And new credit. Too many recent applications can be a red flag. Think of your credit score like a pet dog. Ignore it and it can poop all over your financial life. Take care of it and one day it might just help you buy a house. It's not about being debt-free, it's about looking good to lenders. You could have zero debt but a trash score if you have no credit history. So yes, the game can feel rigged, but if you learn the rules, you can absolutely rig it back in your favor. Let's ponder currency, or money. Here's a mind bender for you. Money isn't actually real in the way a rock is real. It's a human invention, a social construct designed to make trading easier, build systems, and organize society. The only reason a dollar bill can buy you a coffee and a stick can't is because we as a society have agreed to place value on that dollar bill. It's all built on shared belief and trust. So, how does it work? Governments print it, central banks regulate it, and everyday people like us trade it for goods and services. And that regulation by central banks is crucial. If a government prints too much money, inflation kicks in, and everyone's money becomes practically worthless, like monopoly money. But if there's too little money, no one can afford to live. It's a delicate dance to maintain stability. Now for one of my absolute favorites, and arguably the most powerful tool in your financial arsenal: investing. You know about inflation now and how it quietly steals your money's value. Investing is your shield against that theft. It's when your money stops just sitting around and starts working for you. Instead of trading your time for money, you're trading money for more money. Yes, there's risk, but the biggest risk is not investing at all. What can you actually invest in? Stocks? These are tiny ownership slices of companies. If the company grows, your slice becomes more valuable. Bonds? Essentially, you're loaning money to a government or a company, and they pay you back with interest. Funds, these are collections of stocks and bonds, so you don't have to play financial games one by one. Think of them as pre-made investment baskets. Real estate, property that you hope someone else will pay to live in forever, or at least for a long time. Investing isn't about being lucky. It's about being early, diversified, and patient. Most wealthy people didn't win the lottery. They simply gave compound growth, remember that from interest, 30 years to do its thing. Markets will go up and markets will go down. That's the nature of it. But the real danger isn't losing money. It's never investing and watching inflation quietly steal your future wealth. Let's get a little philosophical with value. This is a concept that truly underpins how we earn money. Imagine you pick up a random rock. It's just a rock. Now imagine that rock is shiny and yellow. It's gold. Gold is rarer than an average rock, so we place a higher value on it. It's not inherently worth more, it's worth more to humans because we perceive it as more valuable. Understanding this is key to building wealth. If you can provide a lot of value, you will earn a lot of money. Think about Steve Jobs and the iPhone. He created something with immense value that millions of people were willing to pay thousands of dollars for. It's the same reason doctors and lawyers earn so much. The value of their specialized services is high, and people are willing to pay for it. It's the same reason a luxury brand like Gucci can sell a handbag for 100 times the price of a similar one from a discount store. People perceive the Gucci bag as more valuable, so it is. If you can figure out how to create value, even if it's perceived value, you can make a lot of money. And finally, the most valuable asset in the world, time. And the best part, almost everyone starts with a lot of it. You probably have plenty left, but remember, no one gets an unlimited supply. Most people trade their time directly for money. 1 hour equals 1 paycheck. Simple math. The top earners, however, have figured out how to make their time worth millions. The difference isn't magic. It's skills, leverage, and how well you've trained your hours to work for you. But nowhere does time work harder for you than in investing. There is no greater force in wealth building, not luck, not even a massive income, than time. Because wealth isn't built in days, it's built in decades. Money that sits quietly in an investment doesn't just grow, it multiplies. Slowly at first, then faster and faster. This is how ordinary people with modest paychecks can retire with 7 figures. They didn't beat the system, they used the system. A little money, invested consistently, and given enough time, becomes a lot of money. So, there you have it. A quick tour through some of the most fundamental financial concepts. Understanding these isn't about becoming a Wall Street guru, it's about empowering yourself to make smarter decisions, build a secure future, and ultimately, live a life with less financial stress and more freedom. What financial concept do you want us to break down next? Let me know in the comments below. Don't forget to like this video, subscribe to Finance Intel, and hit that notification bell so you never miss out on essential financial insights. Until next time, stay financially intelligent.